Welcome to this explainer. If you've been feeling that all too familiar squeeze on your wallet around the first of the month, well, you're definitely not alone. Today, we're breaking down the complex web of economic forces that are relentlessly driving up urban rent. We're going to map out exactly what's going on behind the scenes in the real estate market so we can truly understand the mechanics behind those rising monthly payments. Let's get right into it.
Picture this. It's a scenario we almost universally dread. You open your phone and there's an email from your landlord. The message bluntly states that starting next month, your rent is going up by a staggering $300. You sit there running the math, realizing just how much tighter your budget is about to become. And here is the real kicker, right? You didn't get a bigger apartment. Literally nothing about your living situation or the building itself has improved. Yet, you're hit with this massive jump in your living expenses, demanding a way bigger chunk of your paycheck just to keep a roof over your head.
It's a wildly frustrating reality for millions of us. You work hard, you pay your bills on time, and yet the goalpost just keeps moving further and further away. So let's peel back the economic layers and answer the big central question. Why exactly are you paying more? We aren't going to just throw around buzzwords today. We're going to look at the concrete systemic factors that dictate these aggressive price hikes.
Okay, let's jump right into the first major factor: supply, demand, and competition. Right now, in so many cities, the scales are completely tipped. On one side, you have incredibly high demand. We've got a growing population of people eager to rent, whether that's young professionals moving for a new job or families trying to get into a good school district. But on the flip side, you have a severely limited number of homes actually available. Honestly, it's not uncommon to show up to an apartment viewing these days and find a line out the door. And when you have 20 or even 50 people applying for a single vacant unit, the dynamic of the market fundamentally shifts in favor of the property. So it all boils down to that classic basic rule of economics. When demand is exceptionally high and supply is severely limited, prices naturally rise. It is the core engine driving up the baseline cost of living in urban areas all across the country. Because housing is scarce, and because people obviously have to live somewhere, the market value of that property inherently climbs. Landlords know they can charge more because if you say no to the higher price, there are dozens of other applicants ready and willing to sign that lease. Which brings us to our next piece of the puzzle: the hidden costs of ownership.
This is where we see a really fascinating domino effect that traps people in the rental market, and it actually starts entirely outside the rental market itself. It starts when mortgage rates rise. As interest rates go up, buying a house becomes much less affordable. The monthly payment on a standard mortgage skyrockets, which suddenly prices countless prospective buyers right out of the housing market. As a result, those folks who wanted to buy are forced to just keep renting. This injects a massive new wave of highly qualified households right back into the rental pool, aggressively cranking up the competition for the exact same rental homes.
And it's a double whammy, because those rising interest rates aren't just hurting folks trying to buy a house, they're hitting the people who already own the apartment buildings. With higher interest rates, property owners are facing much higher financing costs just to keep their buildings operational. Mortgages on large complexes get more expensive, insurance premiums are rising, and just general baseline operating expenses go up. Basically, when the cost of operating the housing goes up, the cost of living in that housing goes up right along with it.
Now, you might be thinking, can landlords really just pass all these costs on to us? Well, not universally. Ultimately, local market conditions determine how much of these extra expenses can be passed on to the renter. If a local market is weak and units are sitting empty for months, landlords simply have to absorb that financial hit. But in highly competitive markets, like the ones overflowing with people who got priced out of buying homes, landlords have all the leverage. In those strong markets, those increased operating costs get passed directly down to the tenant.
All right, moving on to part 3, barriers to building new.
You'd think the obvious solution is just to build more housing to relieve the pressure, right? Well, constructing a new apartment building isn't nearly as simple or cheap as it used to. The expenses generally fall into 3 main buckets: land, labor, and building materials. Today, all 3 of these foundational elements are significantly more expensive than they were even just a few years ago. Urban land is at an absolute premium. Raw materials like lumber, steel, and concrete have seen massive price spikes, and finding a skilled construction workforce, that's both difficult and expensive. Pulling these 3 elements together makes new construction incredibly risky and costly for developers.
And beyond the physical stuff, the wood and the steel, you've got the red tape. Bureaucratic bottlenecks, specifically restrictive zoning rules and super lengthy approval processes, act as massive artificial barriers. Even if a developer has the capital ready for the expensive land and the costly labor, these local regulations can delay a new project by months, or sometimes even years. And during that waiting period, developers are just bleeding money holding the land. It's a massive friction point that chokes the housing supply, actively preventing it from expanding quickly enough to meet our demand.
So let's get to the million-dollar question. Will rent ever actually drop?
The short answer? Maybe. Rent growth may slow or even actively decline in some areas, but it is highly dependent on a few specific triggers. We need a fundamental shift in the ecosystem. Either a ton of new housing must be built to finally relieve the supply pressure, or overall renter demand needs to somehow slow down, maybe by people moving out of the city or consolidating households with roommates. Alternatively, shifting local economic conditions, like a major industry leaving a town, could force a broader financial reset in the area.
The catch here is that there's absolutely no one-size-fits-all magic wand. Why? Because every single city is fundamentally different. Rental prices are influenced by a unique, highly localized blend of economic factors. The real estate dynamics, job growth, and housing policies in a booming tech metropolis are completely different from those in a quiet Midwestern suburb. What causes rent to drop in one zip code might not move the needle even a fraction of an inch in another.
If there's one big takeaway from this explainer, it's that your rent doesn't increase because of just one isolated reason. There is no single villain secretly twisting a dial to raise your rent. Rather, it's a complex, interwoven web. It is the combined forces of basic supply and demand, rising financing costs tied to national interest rates, surging physical construction expenses, and restrictive local housing policies all crashing together simultaneously to drive up your cost of living.
Understanding these deeply interconnected forces perfectly explains why finding an affordable place to live has become one of the absolute biggest financial hurdles for millions of everyday people. We've mapped out exactly how the economic machine works, which leaves us with one vital, final question to chew on. Will local markets and housing policies shift fast enough to finally solve this crisis?